In today's class, let us discuss about the classification of goodwill. So, there are two classifications, namely the acquired or the purchased goodwill and the self-generated goodwill. So, let us discuss about the acquired or purchased goodwill. So, it is to be noted that in this case, payment will be made in cash or kind. So that is what is called as the acquired or purchased. Maybe it could relate to goodwill. And then when it is actually arising, so this arises probably when there is a purchase. When there is a purchase, this is a time when the business should actually fetch an actual price. So next it says that the price paid for the purchase of such business may exceed the net assets of the acquired business. So it is to be noted that the net assets is what is to be taken into consideration. How can you find out or calculate this net assets? It is simple. Just you have to find a difference between the assets and the liabilities. So assets minus liabilities will give you this net assets. And it is also to be noted that the excess of the purchase consideration. So what do you mean by consideration? The amount that we have to pay for it over the value of net assets acquired is actually treated as the acquired goodwill. And it is also to be understood that according to the accounting standard 10, so the accounting standards 10 actually states that every firms that will go for this purchase, it states that goodwill must actually be recorded. So it is a mandatory thing, it is a compulsory thing that in the books of accounts that such a consideration that has been made in money or money's worth have to be actually accounted. So whatever payment is made towards this purchase have to be noted very clearly in the books of accounts. And not only that, this acquired goodwill can be recorded in the books of accounts, and also how it will be shown means in the assets part of the balance sheet under the maybe list of fixed assets, because all these goodwill will denote the fixed assets, because under that we categorize them into tangible and intangible asset. Goodwill being an intangible asset, we will be actually recording in that part. So let us also consider another aspect of calculation of this acquired price. So here you can see that this goodwill can be also stated as maybe the purchase is assets minus liabilities. Purchase is actually the assets minus the liabilities. So here it states very clearly that once this calculation have to be found out, P stands for purchase price of the target company, which one has to be purchased. Then A stands for the fair market value of assets, and liability stands for the fair market value. L stands for the fair market value of the liabilities. Now coming to the self-generated goodwill. So the meaning itself is stating that it is generated by itself due to certain reasons of factors. So the factors could be like favorable location. So it is a favorable location. That means where it is located. So already we have discussed in our previous topic. You may just look onto that video. Loyal customers with a solid base, and especially they should have the advantage of this intellectual property rights. So what do you mean by intellectual property rights? So this refers to certain maybe intangible assets that the firm has acquired in its process, like the patent, copyrights, trademarks. And of course there should be a very good brand identity, a recognition. So if the brand has a standing in the midst of the market, then definitely there will be good amount of goodwill. And to say there should be also a very good and solid or maybe sound friction free employee relations with the management, and also they should have a very good proprietary technology. So their technology will, it will just outdo the other technologies of the competitors. That means their technology is unique and it's going to be theirs, so which would have added to more patents for this. The next topic will be to calculate various ways about goodwill. So methods of valuation of goodwill. The first one is going to be of the average profit method. So here it says that a certain number of years of purchase, certain years of purchase of average profit based on the past few years, will be actually adopted here. So it says number of years of purchase determined on the basis of the average period of a new business will actually determine this average profit method. Also, in the case when it is to be earned in the future, also it is determined the basis of number of years for which the average profit will be earned. So here there could be certain adjustments that have to be made while actually finding out this profit. So here a calculation is to be made. There will be the adjusted profit, what we were discussing now, and it will give rise to actual profit. So from the adjusted profit we will have to actually make certain adjustment, like certain additions and certain subtractions. So where it will be added, what circumstances? When there are past expenses and these expenses may not be required in the future. Secondly, there is an income, additional income, which is also not going to take place or expected in the future. What needs to be deducted? Past revenues, not likely to be earned in the future. This will not happen or occur in the future, cannot be earned. Likewise, additional expenses need not be paid in the future. So when these adjustments are made, this will give rise to actual profit. So adjusted profit with all these will give rise to actual profit. Next will be about the simple average profit method. So here we can easily remember with the help of a formula. So before that, let us see what is this method all about. Just you need to calculate by a multiplication of the average profits by certain number of years of a purchase. So we can just for that, initially you will have to total up all the adjusted profits of certain years. It will be given, and in the case of loss you will have to deduct that. If there is a loss in a particular year, that needs to be deducted. This will give rise to total profit, and that you will be dividing by the number of years. And so thus you can say that total profit is equal to average profit is equal to total profit by number of years of number of given in the problem. So thus you can easily arrive at the goodwill value, which says under this method it is average profit what has been found previously multiplied by the number of years of purchase. Number of years of purchase also will be mentioned, and that will give rise to goodwill under simple average profit method.